Hello again, Josh Carr here. Today I'd like to do a reaction video. It's funny, there are all these reaction videos online where someone like watches a movie and reacts to it or listens to a song for the first time, all that sort of thing. But what I haven't seen a lot of is reaction videos to actual Excel modeling content. So let me talk about this a little bit. I get a lot of Excel models. I've seen a lot of Excel models. I've built a lot of Excel models. I've been doing this for 20 plus years. And some models are good and some models are bad, but all of them need fixing. And very common conversation I have with people when they're first approaching the modeling thing for the first time is just like, how do I build a financial model? Like, where do I even start? So I thought what might be instructive is to go through an actual model where I've removed some names to protect entities and things and stuff. And these are just models that I've received over the years where I've removed names, and we can go through like what the model is, how they built it, things they could have done differently, that sort of thing. So this is an industrial model. It's a commercial real estate model. It's an acquisitions model, and I'm going to go through piece by piece. I'm going to talk about what they did, what they didn't do, how they should have done it differently, and hopefully this will explain some of my process and how I approach problems, and how maybe you could approach problems. With that said, let's get into it. So to start with, it's all about the tabs. We have here 8 tabs, as you can see down at the bottom. One thing I always like to check is to see whether or not there are any hidden tabs. To see if there are any hidden tabs, you can go to unhide, and it'll show if there are any hidden tabs. Nothing shows up here. If you want to get a little crazy, you can even go to view code, and you can, under view code, take a look at the project file, and you can see whether or not there are any very hidden tabs. There are not in this case, so what you see is, as the old saying goes, what you get. And I guess the place to start from first off is there's an Argus tab. So obviously I don't know how much experience you have building financial models, but a lot of people will use Argus as a cash flow modeling tool. They'll use it because building complex office leases, industrial leases is really a pain in the tail. I'm not saying you can't do it. I'm not saying Argus does anything with math that couldn't be rebuilt in Excel. But a lot of people, just for ease of use and saving time, will build stuff in Argus. So in this case, it looks like they built it in Argus and then they dumped the cash flow to a tab. Now, most people will use Argus to build an unlevered cash flow. But the moment you start to talk about leverage and you start to talk about equity structures, well, then you're back to working in Excel. So what I think we're going to see, and I haven't looked in this spreadsheet for years, I think what we're going to see is that that's exactly what they did here. You'll notice there's nothing here for debt service in the Argus model. It looks like they used Argus to build unlevered cash, and then they're going to use, Excel for the rest. We have some capital items. We have some OpEx. That's all normal stuff. Down here at the bottom, or I should at least say up here, these cells, and this is common, people will like dump the Argus information down here, and then usually up here at the top, there might be some formulas, because we might be pulling that information from the information down here. You can see if I just throw some arrows on this bad boy, that's exactly what they did. They're drawing it from below. That works. I'm not going to say that's bad, but what would have been better, I think, would have been use some VLOOKUPs or something like that. So like usually the way I like to do it is to have the Argus data and what it links to, and use some VLOOKUPs to like automatically pull things, like the line item with the name of, potential gross revenue. Or maybe instead of linking to CAM and insurance and taxes and management fee and those values, you could have like more lines here. So not just like the 4 lines, but link like 10 lines. And then if you have extra lines, You could do like an if statement that says, hey, if you don't see anything, blank it out or something. Something that just makes this more reusable. So I'm not saying this is bad. I'm saying this could be better. Okay, so again, you could do some lookups. You could do some if statements, something to make this a little bit more automatic. You don't need to do it, but anything you do that automates the process is always, of course, better. On the side here, it looks like they have some simple, just, compounded annual growth rate calculations. You'll see that in models like this sometimes. What this is telling me is, hey, how fast are expenses growing? How fast is rent growing? Obviously, it's better if rent grows faster than expenses, but then the question is, of course, why? If it's just inflation, it would affect everything the same. If you are getting rent growth, is that because the market is better? Like, what's driving that, basically? Those would be conversations we'd have. One of the problems of building this in Argus and not in Excel is you can't see that underlying information. Now, what they did in this case, so you could see some of that underlying information, is we have another tab here, which I will make much bigger, where it looks like they took actual printout stuff from, from the Excel file or something like that. They took actual printout stuff, not from the Excel file, I'm sorry, from an Argus report, and they just replicated it here. So we have a list of tenants, we have some square footages, we have some expiration dates. You get the idea. Cool. What else can we see? We have a debt financing worksheet. Now you'll notice I haven't really talked about the worksheets on the top yet. I like to look at the subsheets first usually because it's kind of like reading the details before you get to the big picture. Like, we're going to get to the big picture in a moment, but I want to understand some of these like backup sheets because that'll give us an idea of where we're going here. Too often if I look at the first sheet and I just see the answer, I'm like, well, that's great, but I want to understand what's underlying it. So often I'll start with the underlying sheets first, just so I have some idea of where the narrative is going. In this case, we have a debt schedule. Let me change the view, put it to normal, make it bigger, because bigger is, in this case, better. And it looks like we have some loan information. We've got the amount of debt. We've got something about what the interest rate is. That's all fine and good. We've got an annual payment. Here they're doing it on a 12-month schedule. That's good. I mean, if you want to get mental about it, you could be like, well, let me calculate based on how many days are in the year and what the compounding rates are. I mean, don't get me wrong. If you go to a bank, the bank will actually do debt calculations based on how many days are in the month. But the difference between daily calcs and monthly calcs, not that substantial. So probably not really worth getting into. It looks like here there's no principal payments for the first few years. There's no if statement driving this. It looks like they just zeroed that out. So I'm betting you it's interest only for a period of time. That's not the most elegant way of doing it. It's nicer if you build something that says, if there's an interest only period, then zero this out. Again, it's all about flexibility. You want to build worksheets, so you only have to build them once. In any event, beginning of year principal, amortization, interest, annual payment, you get the idea. It doesn't affect everything, but obviously misspelling words is inadvisable. Probably want to spell amortization correctly, or, just all things being equal, wouldn't kill you. I mean, it's fine that they called it amortized payment, I guess, but whatever. That's a trivial point. I'm not even going to get into that. In this case, we're amortizing over a 30-year schedule. Not to get too picky here, but often if you have 3 years of interest only, it's much more common to see a lender say, hey, I was going to give you 30 years of AM, but now that there's 3 years of IO, of interest only, I'm giving you only 27 years of AM. I don't know if that was the case here, and just the guy who built it was lazy and didn't subtract the 3 years. I'm voting on lazy, but again, who knows? Let's look at how that feeds into the cash flow statement. And again, let me make this a heck of a lot bigger because the zoom thing's a problem. So this is okay. We've got, it looks like a lot of information from Argus. That's your cash flow. And there's some vacancy. And there's your OPEX. And this interest stuff is all from the debt financing page. And that gets us to cash flow before capital. Okay, fine, so far so good. Looks like the dates are being done right. A little EO month function to push thing 12 months out. That's all fine and good. And down here, it looks like they then have your leasing and capital. That's all fine and good. It looks like they had a section here at one point to say, do we need to draw down additional cash from the lender? You know, probably what was going on here is if your debt coverage ratios were not high enough, that is to say, if you couldn't service the debt, you might need to draw down some money, you know, or if there was a shortfall, maybe you had a working capital to say, hey, for this 1 year, my debt coverage isn't sufficient. I'm going to infuse some money into the deal. But it looks like this is a cash flow producing deal, so everything's fine. The fact that these sections even exist here tells me that they had other deals where that was an issue, or maybe it was an issue here, and then something happened, and now it's not an issue. But this layout is pretty good. It's basically saying this up here is the money before debt. This is after debt. And then you get into the flows of, are you putting in capital dollars? Are you making long-term improvements? And if so, how are we funding them? Are we funding them possibly out of additional proceeds from a lender? But this flow is normal and natural. Again, this is the way an acquisitions person would look at it. I realize if you have an accounting background, you might be looking at this and be like, hey, this isn't something I've seen before, but for a deal person, this is the way a deal person would think of it. We have an assumptions page. The assumptions page, in theory, should show everything that a user would need. What do we see here? Some of this stuff is copy-pasted right from, you know, Argus. For example, someone just typed in the renewal probability, or the new tenant rent, or the upon renewal TI cost. This blended thing is color-coded like it's in input, but it's a formula. That is just sloppy. Let's talk about that for a moment. It is very common to make your inputs one color and your formulas another. One way to catch that kind of problem would be to say, let's go to Home, Find and Select, go to Special, Constants that are numbers only. And if I do constants that are numbers, it will highlight everything that's a constant and a number and sort of tell you what should be color-coded. As you can see, some things that are color-coded blue are actual formulas. Some things that are constants are color-coded black. There's some messiness here. This is something we'd want to fix. I usually will do that little trick to say Home, Find, Select, go to Special Color, and then color-code it accordingly. Basically, if I go up here and I just am like, hey, let's make this all, I don't know, green or something. Now magically it's all green. I would not make things green. That's not a color people tend to use for this, but again, I'm giving you an idea of the flow of how we might handle this. Okay. So what's going on this deal? It looks like it's industrial, and it's 300,000 feet. We've got some assumptions here. Some of these assumptions, again, look like they were ripped right out of Argus. That's all fine and good. We've got an inflation rate of 3% across the board. That's fine. It shows what we're buying it for and what we're selling it for. Oops, sorry about that. We've got information about what we're buying it for at a cap rate going in and going out. You know, cap rates are kind of magic. I mean, if you buy it at 5.6 and you sell it at a 7, there's quite a lot of spread there. So things would have to get a lot worse. It's basically suggesting that you're going to sell it at a yield that is not favorable to you. You know, when you're looking at cap rates, you might look at long-term trends of what things have traded for. You'd look at credit quality. This is an industrial building. Who are the tenants? What's their credit ratings? What's going on with them? In this case, we have none of that. We have a list of tenants, but there's no credit data about them. And I get the fact that they ripped this right from, like, you know, an Argus schedule, but like some sort of credit analysis would have been nice. Anyway, we got an equity and debt breakdown, and here we see sources and uses. In other words, where does money come from? Debt and equity, in other words, a bank and the investors. And where does it get used? Okay. And this is basically trying to say what is funded up front versus what is funded over time. So for example, we have here for up front, buying it, recording, legal, prepaid expense adjustments. Let's talk about that. What is a prepaid expense adjustment? Often lenders will insist that some of your expenses are paid out of pocket, like in this case, some taxes, some insurance. So what we should see is that if you're prepaying some of your expenses at closing, we should see in the Argus file that some of these expenses would be lower. And we do not. That looks to me to be a boo-boo. So for example, it's saying here, hey, we're prepaying a year of insurance and a couple months of taxes. Okay. But when we look at the Argus file, we see here that insurance is basically stable and taxes, well, they're going up, but either way, if you're prepaying a year of insurance, you would expect this to be adjusted. Now, they may adjust it somewhere else, but for right now, that looks like a boo-boo. Again, financial models, mistakes are made, and sometimes people catch them when reviewing them years after they're built. And by the way, I chose this one out of bucket kind of at random. I have literally like 100 of these. So if as I'm doing this, this excites you and you want to see other kinds of financial models and you want me to tear apart other ones, let me know. I have an incredible number of them. Anyway. In this case, we have a breakout for fees, property management fee, looks like some sort of adjustment on the purchase price. Okay, that's kind of a weird place to put that. I would usually think if there was an adjustment on the purchase price, we'd see it up here, but for some reason it's down here. That strikes me as odd. Okay. You know, one question I always like to ask when I'm looking at these things is, who is this being built for? Is this being built for the investor, or is this being built for internal use? The fact that it's kind of choppy in its layout tells me it was probably built for internal use, or It was built for a sophisticated enough investor that they didn't need it all pretty and color-coded. When you're building things for the uneducated, you need more color coding. You need it to be prettier, you need charts, you need graphs, you need all that junk. This is very raw, if you will. But again, if you're building it for a more sophisticated user, then maybe raw is fine. Anyway, we got levered and unlevered yields. Levered is coming from the cash flow page. Unlevered is from the returns page. We'll get to the returns page in a moment. Same thing with the IRR calcs. Okay, fine. In this case, it looks like you've got an investment group and you've got a managing member. And it's about a 99-1 split. Okay, fine. We're going to look at the return profile in a bit, or the return structure, but that's what we've got here. There was some other entity here whose name I changed. So I don't know what's going on with that, but I changed that name. Let's keep going. Oh, and I should have also said there are a bunch of data tables over here. Data tables are a way of saying as we vary something like, say, a hold period and a cap rate, what do we get for returns? If you want to build a data table, that's all under the what if analysis section. The main warning I give people when you build data tables is it slows down models, right? So if you're building a data table, you probably want to make sure that later you play with the calculation options to like put it to partial, to slow it, to not be running data tables all the time. I mean, having 4 tables on something this simple, that's fine. But obviously on really big models, the tables are going to become crushing. It looks like this table here is broken because even when you vary the spread, this does not change. I don't know what's going on over there. But that's a clear indication that that table is broken. Final few tabs to talk about. We've got this sensitivity table, so sensitivity worksheet. Now this is relatively common. Someone will build data tables on the assumptions page because you have to build it on the assumptions page because that's just the way Excel works. And then they'll say, well, now we need to make it pretty so that I can print it out. This has been formatted for printing, and this is just linking back to the assumptions page. This page only exists for reporting purposes. So while this model is a little clunky and maybe not that pretty, this tells me that this was built for reporting purposes. We've got some sort of capital account workbook. It looks like we're keeping track of what money went in and what they got paid back. In this case, this is not a pref model. So it looks like it's just someone putting in money, getting back money. It's their money. They're not being owed a rate of return on it. They're not like an investor. This feels to me more like a family office model. Someone internally who used this for their own deal. And it looks like while there are, or there is, I should say, like an investment group and a managing member group, it looks like they're sitting in the same seat. They're receiving the same rates of return. So this is not like a sponsor, investor, we have a waterfall joint venture thing. This is just someone saying, I put in money, I get out money, what's my rate of return? Very simple structure. Which then gets me finally to returns. And in this case, it looks like someone is just saying, change the view again to normal. What's my yield on my money? What's my rate of return over the life of the thing if it's just an IRR calculation? And what's my rate of return on a levered basis? And that's kind of just what it is. You'll note, and this is probably the only interesting thing about this page here is, we have here on line 18 something that says, as I vary the sale year, then put the sale date, put the sale value into that cell. So, like, this is basically just saying, take the forward 12 months NOI, cap it, come up with the sale price. Now, what's interesting to me is if I change the hold period in C32 to 5 years, we should see that the forward 12-month NOI, which is coming from line 19 on the cash flows page, line 19 on the cash flows page is just saying that this is just a series of if statements to say, let me figure out where the forward 12-month is. This is not an elegant way of doing this. What this person did, which is really not elegant at all, is they basically just said, based on if it's 2 or 3 or 4, basically pull the value down based on the year you're selling it in, and then to figure out the forward 12-month number, they have here a couple if statements to say, like, is the year I'm in, like, this is basically just saying, if it's in year 2, make that a 1. If it's a year 3, make that a 1. If it's a year 5, make it a 1. And this is saying, if it's 5, make it a 1. If it's 4, make it a 1. And this is then comparing those. And it looks like it's just basically pulling that value down based on the year you're in. This is not elegant at all. What they really should have done is something like look for the date on the NOI schedule, then use the appropriate NOI using like an X lookup or an index match. But to actually hard code this and be like, if this is year 4 or year 5 or year 6, bring it down, that's just clunky. It's just clunky. Again, I'm not saying you can't do it. I'm just saying you shouldn't do it, right? You want something more flexible, more robust. That's a better way of working through models. Anyway. So, let me put this back to 10 years. And close that. Cool. I usually don't use these plus and minuses on the side, but people like to do that sometimes. People like to, like, group the cells and stuff. Again, not a big fan. But, you know, that's kind of what it's doing. It's doing unlevered. It's doing levered. And I guess down here, because these two entities are just, you know, the exact same shoes, so to speak, they're just getting the same rates of return. There's no outside investor. If they had had an outside investor on this deal, there may have been a pref and a split or something. Financial models are always easier when you don't have outside investors, and you're just like, hey, it's my money, I put it in, I get it out, it's fine. You know, so anyway, so big picture, you know, how would I have built this? I mean, if I were to summarize my thoughts here, there's nothing wrong with the model. I mean, well, let me back up here. There are a couple things. First off, it looks like there were extra prepaid expenses on the assumptions page. That's a problem, right? There should have been an adjustment somewhere to say, and I'm pretty sure there isn't, there should have been an adjustment to say, if I'm prepaying expenses at closing, then we need to actually adjust what the OPEX is. And it's not doing that. It's just taking the OPEX right from the Argus. So that's one problem. But that's okay. We're being overly conservative. We're overstating upfront costs. It's not the end of the world. I'd also say that, you know, this is a pretty straightforward deal. We're just basically, looks like buying a fully operating industrial building. I mean, we don't really have any of the detail. everything was built in Argus. If you build everything in Argus, it's kind of hard to figure out what's actually going on. Like the interesting stuff here is really happening in Argus. This Excel model is more of like a wrapper to the Argus file to put some debt on it and to do some return calculations. What would have been interesting, I think, is if there was more stuff in here about like credit quality of the tenants, some sort of understanding of like what the yields were, like the bond yields on their credit quality, like some understanding of what's driving this deal. We don't have any of that underlying data, So when it says market rent is 6 to 7, and it looks like you've got some accelerated growth at the beginning, we don't know how that market rent compares to what the tenants are currently paying. I mean, you could go to the lease expiration schedule and you can see what the square footages are, but I don't have any understanding here on, are these tenants below market and by how much? I mean, I can look at the Argus file and I can see that there's some compounded annual growth, but I don't know what's driving that. Which tenants are below market, by how much? Heck, are some of the tenants above market and they're expiring and then a below market tenant is canceling them out? We just don't have that detail. If you're going to build stuff in Argus, you need to bring some of that information to the top level, to this Excel model, and maybe that's just retyping, but if you don't do that, I just don't know what to do with it. It's not giving me enough detail to work with and to really understand big picture. Is this rate of return a good deal or not? We just don't know. So, yeah, some mechanical sloppiness and lack of detail, a little bit fuzzy. Those would be things I'd lob against the model. It's not bad, but it's also not good. This is like a B. Anyway, that's me tearing apart another person's work for 30 minutes. Hopefully you found this constructive in terms of how you should at least look at a model and think about it a bit. I will be doing more of these reaction videos to Excel models. If you have an Excel model you would like me to critique, comment, and share my love of, send one to me. I will remove names as appropriate, or if you feel you need to remove names as appropriate, that's fine too. Every model can be better, and hopefully you found this to be useful. If you want to check out more of my content, obviously, YouTube, like, subscribe, or you could also go to my website at kahrrealestate.com. Those are all places you can check me out. And if you have a model you want to send me, email me, josh@kahrrealestate.com. Groovy. Thanks again for joining me, and until I see you next time, keep building better models.